Have you ever wondered why everything feels more expensive, but your paycheck doesn't seem to go any further? You're working just as hard, maybe harder, but somehow rent costs more, groceries cost more. That coffee you used to grab without thinking twice now makes you pause. Meanwhile, you keep hearing about billionaires getting richer, stock markets hitting record highs, real estate prices soaring, and you're left wondering, what am I missing? Here's what nobody talks about. There's a invisible mechanism transferring wealth from your pocket to the already wealthy, and it happens every single time the government prints money. I know that sounds like conspiracy theory stuff, but stick with me, because what I'm about to show you isn't a conspiracy, it's just economics. And once you see how it works, you can't unsee it. Here at Simple Money, I've spent years studying how monetary policy affects everyday people, and today I'm going to walk you through exactly why printing money doesn't help the average person. In fact, it does the opposite. By the end of this video, you'll understand the hidden wealth transfer happening right now, and more importantly, you'll know what you can actually do about it. Let's start with what most people think happens when the government prints money. The government needs to spend money. Maybe there's a crisis. Maybe they want to stimulate the economy, so they print more money and inject it into the system. In theory, this should help everyone equally, right? There's more money flowing around, businesses get loans, people get stimulus checks, everyone benefits. That's the story we're told, and on the surface, it makes sense. More money equals more prosperity. But here's what's really happening, and this is where things get interesting. Money doesn't get printed and distributed evenly like rain falling on everyone. It enters the economy at specific points, and whoever gets that new money first gets to spend it before prices adjust. Think about it like this. Imagine you and 9 friends are on an island. You each have 10 coconuts, so there are 100 coconuts total, and each coconut is worth 1/10 of the island's wealth. Now, imagine someone drops 90 more coconuts on the island, but they all land in your friend's hut. Suddenly, there are 190 coconuts total. Your 10 coconuts are now worth less relative to the total supply. But here's the key part. If your friend spends those 90 new coconuts before everyone realizes there are more coconuts in circulation, they get full value. They can buy half the island before prices adjust. By the time you try to spend your coconuts, everyone knows there are more coconuts around, so prices have gone up. Your 10 coconuts now buy less than they did before. That's not a metaphor. That's literally what happens with printed money, and it has a name: the Cantillon effect. The people closest to where money is created benefit, everyone else gets diluted. The first mechanism is what I call the first mover advantage. Here's how it works in the real world. When the Federal Reserve creates new money, they don't mail checks to everyone. They buy assets from banks, government bonds. Mostly, banks now have more cash, they can lend more, they look for borrowers, and who gets access to these loans first? Large corporations, real estate investors, people with assets and good credit, the already wealthy. These borrowers take out massive loans at low interest rates. They use this newly created money to buy assets, stocks, real estate, businesses. They're spending before prices have adjusted. Meanwhile, what's happening to you? You're still working your job. Your salary hasn't changed. You haven't suddenly gotten access to millions in cheap loans. By the time you see any benefit from this new money, maybe through a slight wage increase or a small stimulus check, prices have already started rising. You're late to the party. Here's a real example. During the pandemic, the Fed created trillions of dollars. Stock market soared, real estate prices jumped, billionaire wealth increased by about 40% in just 2 years. Did your wealth increase by 40%? Probably not, because you weren't first in line for the newly created money. The psychology behind why people don't see this is fascinating. We think of money creation as this abstract government thing that doesn't affect us directly. We focus on our paycheck going up 2% and miss that prices went up 5%. It's like being on a treadmill that's slowly speeding up. You're walking faster, but you're not actually moving forward. You're just working harder to stay in the same place. The first mover advantage means that wealth transfer isn't a bug. it's a feature. The system is designed to benefit those closest to money creation. The second mechanism is what I call the asset inflation escape hatch. This one's particularly cruel because it widens the gap in a way most people don't even notice. Here's what happens. When new money floods into the system, it doesn't inflate all prices equally. Some prices rise faster than others. And the prices that rise fastest are assets, stocks, real estate, bonds, businesses. Why? Because the people who get the new money first are investors. They're not buying more groceries. They're buying investments, so investment prices skyrocket while everything else catches up more slowly. If you own assets, your wealth increases fast. Your house value goes up, your stock portfolio grows, you're getting richer, not because you did anything, but because new money is chasing assets. If you don't own assets, you just experience the downside. The cost of buying a house goes up. Rent goes up because landlords' property values went up. But your savings account, still the same nominal amount, worth less in real terms. This is the escape hatch. Asset owners escape inflation by owning things that rise in value. Everyone else is trapped, watching their purchasing power erode. Let me give you some numbers. From 2020 to 2022, the median home price in the United States went up about 40%. The stock market, despite some crashes, gained significant value. Meanwhile, average wages went up maybe 10 to 15%. If you owned a $400,000 house, you gained about $160,000 in equity. You didn't work for it, you just owned an asset while money was printed. If you didn't own a house, you now need to save $160,000 more to buy the same house. You got relatively poorer without changing anything about your behavior. Here's why our brains struggle with this. We think wealth comes from income, from working hard and earning money. And that's true for most of us. But for the wealthy, most wealth doesn't come from income. It comes from assets appreciating. And asset appreciation accelerates when money is printed. They're playing a completely different game. And most people don't even realize there are two games happening. The third mechanism is the debt advantage. This one flips everything you've been taught about debt on its head. You've probably heard that debt is bad. You should avoid it. Pay it off as fast as possible. And for consumer debt, credit cards, car loans, that's often good advice. But here's what wealthy people understand about debt that most people don't. When money is being printed, debt becomes a tool for wealth transfer. Here's the mechanic. You borrow $1 million at 3% interest to buy an apartment building. The government prints money. Inflation runs at 6%. Your debt payment stays the same in nominal terms, but it's getting cheaper in real terms. Meanwhile, the rent you charge goes up with inflation, and the value of your building goes up with asset inflation. You're making money on both ends while your debt gets easier to pay. You borrowed old, expensive dollars, and you're paying it back with new, cheaper dollars. That's wealth transfer in your favor. Now contrast that with someone who doesn't have assets and can't access cheap debt. They're just experiencing the inflation part. Their rent goes up, their groceries cost more, but they're not benefiting from debt getting cheaper because they don't have productive debt. The wealthy took on massive amounts of debt during periods of money printing, not because they needed it, but because they understood it would be inflated away. Here's a specific example. Real estate investors who borrowed heavily in 2020 are now paying the same mortgage amount, but that amount represents a smaller portion of their rental income. Their tenants are paying more in rent, but the landlord's expenses stayed flat. The landlord got richer, the tenant got poorer, not because of work or skill, because of understanding how printed money affects debt. This is why you hear about companies taking on billions in debt at near zero interest rates. They're not desperate, they're exploiting the debt advantage. Our brains rebel against this because we've been taught debt equals risk, and for individuals without assets, that's true. Credit card debt will destroy you, but for asset holders, strategic debt during money printing is a wealth multiplication tool. The people who know this are getting leveraged. The people who don't are staying in cash, thinking they're being responsible while getting quietly decimated. The fourth mechanism is what I call the velocity lock. This one's more subtle, but it explains why printed money doesn't actually trickle down the way we're told it will. Here's the concept. Money has velocity. That means how fast it moves through the economy. High velocity means money changes hands quickly. Everyone's spending. Low velocity means money sits. When the Fed prints money and gives it to banks, that money doesn't automatically start circulating. Banks can just hold it. Large corporations can buy back their own stock. Wealthy individuals can park it in assets. The money enters the system, but it doesn't flow down to regular people. It gets locked at the top. Meanwhile, what little money does make it to average people gets spent immediately. You get a stimulus check, it goes to rent, groceries, bills, it flows right back up to corporations and landlords. So printed money accumulates with those who already have money, while it flows through the hands of those who don't. The rich get to hold and invest it, the poor get to spend it and pass it along. Think of it like a water system. Water gets pumped to the top of the mountain. The people at the top have reservoirs. They collect it, store it, use it for their gardens. The people at the bottom only see water when it's rushing past them in a stream, impossible to hold on to. Here's why this matters. During major money printing events, we're told this will help everyone. More money in the system means more prosperity, right? But look at what actually happens. Savings rates for the wealthy go up. They're accumulating. Savings rates for the poor go down or stay flat. They're still living paycheck to paycheck, just with bigger numbers. The velocity lock means printed money doesn't distribute. It concentrates. And it does so naturally, following the path of least resistance in the financial system. This is particularly insidious because it looks like helping. The government can point to trillions in stimulus and say, "Look what we did!" But the actual effect is wealth concentration, not wealth distribution. The fifth and final mechanism is the knowledge gap. This might be the most important one because it's the one you can actually do something about. Here's the reality. The wealthy understand how money printing affects the economy. They have financial advisors, they read economic reports, they position themselves accordingly. When they see expansionary monetary policy coming, they move into assets. They take on strategic debt. They invest in things that will appreciate when money is printed. Most people have no idea any of this is happening. They just notice prices going up and wonder why they can't get ahead. They keep their money in savings accounts, thinking they're being responsible, while that money loses value. The knowledge gap isn't about intelligence. It's about access to information and understanding how to interpret it. And that gap is maintained in part because this stuff isn't taught in schools. You learn algebra and Shakespeare, but nobody explains the Cantillon effect. Nobody teaches you that inflation isn't uniform. Nobody reveals that monetary policy has winners and losers. So most people operate with an outdated understanding of how money works. They think working hard and saving is enough. They don't realize the rules of the game changed. Meanwhile, people with financial education see money printing as an opportunity. They know it's coming, they know how to position themselves, and they profit from everyone else's confusion. Here's what makes this particularly unfair. The complexity is a feature, not a bug. If everyone understood how this worked, there would be massive political pressure to change it. But as long as it stays confusing, as long as people think their struggles are personal failures rather than systemic outcomes, the system continues unchanged. The knowledge gap ensures that wealth transfer happens quietly, invisibly, with most people having no idea they're being affected. Now, here's where things get really uncomfortable, because what I've described isn't a conspiracy, it's not even malicious in intent. The Federal Reserve isn't sitting around plotting to make rich people richer. They're trying to prevent economic collapse. They're trying to stimulate growth. They're working with the tools they have. But the tools they have inherently benefit asset holders. That's just how the monetary system is structured. When the choice is between economic crisis and printing money, they print money. And every time they do, the same wealth transfer happens. The people making these decisions aren't evil, but they're also not like you. Federal Reserve officials, on average, are quite wealthy. They own assets. They're financially sophisticated. The policies that seem neutral to them have very different effects on different classes. It's like when a fish doesn't notice the water. If you're wealthy, if you own assets, if you have access to cheap credit, monetary policy just feels like normal economic management. But if you're working class, if your wealth is your paycheck, if you're priced out of asset ownership, each round of money printing pushes you further behind. And here's what nobody wants to admit: this isn't fixable within the current system. As long as money creation happens through banks and asset purchases, as long as we have a debt-based monetary system, this wealth transfer will continue. Every crisis will be met with money printing. Every money printing event will concentrate wealth, and the gap between asset owners and workers will grow. I'm not saying this to be depressing. I'm saying it because understanding the game is the first step to positioning yourself better within it. You can't change the system, but you can change how you interact with it. Let me tell you about David. He's 42 years old. He works in IT and makes $75,000 a year. David is financially responsible. He saves 10% of his income religiously. He's got $45,000 in his savings account. He's proud of that. It took years of discipline. David doesn't invest because it feels risky. He remembers hearing stories about people losing everything in the stock market. He figures slow and steady wins the race. Build up savings. Maybe buy a house someday when he has enough for a big down payment. Then 2020 hits, the pandemic, massive economic uncertainty. David's glad he stayed safe in savings. While everyone else panics about their investments, his savings account balance stays exactly the same. But here's what David doesn't see happening. The Federal Reserve prints trillions. Stock markets recover and soar. Real estate prices jump 30, 40, 50% in some areas. That house David was saving for, it was $400,000. Now it's $550,000. He needs $150,000 more, and he only saved $45,000 total over years of work. David's savings didn't shrink in nominal terms. He still has $45,000. But in terms of what it can buy, especially the house he wanted, he's way worse off than before. Meanwhile, inflation is running 6 to 7%. His savings account pays maybe 0.5%. Every year, he's losing 5 to 6% of his purchasing power. David followed the responsible advice: save money, avoid risk, be patient. And he got quietly decimated by a system he didn't understand. He's not stupid, he's not lazy, he just didn't know there was a wealth transfer happening. Nobody told him that safety in savings meant vulnerability to inflation, that avoiding investment risk meant accepting the certainty of erosion. David represents millions of people who did everything right according to conventional wisdom and ended up falling further behind anyway. Now let me tell you about Rachel. Same age as David, makes the same $75,000 a year. Started with the same financial position, but Rachel did something different. She spent time learning about how the monetary system works. She read about inflation. She understood that money in savings loses value over time. So Rachel kept 6 months of expenses in savings as an emergency fund, about $15,000. Everything else, she invested in a diversified portfolio of index funds. When the pandemic hit, Rachel's portfolio dropped 30%. It was scary. She lost $10,000 on paper, but she understood this was volatility, not permanent loss. She kept contributing, she didn't sell, and over the next 2 years, as the Fed printed money and asset prices soared, her portfolio didn't just recover, it grew massively. That $30,000 she had invested, it's now worth $75,000. Plus, she kept contributing during the crash, buying assets when they were cheap. Rachel also used the low interest rates to her advantage. She bought a small condo in 2020 with a low down payment and a 3% mortgage rate. That condo has appreciated 40%. She's gained $60,000 in equity. Same income as David, same starting point. But Rachel understood the game. She knew that printed money flows into assets. She knew that inflation favors debt holders and asset owners. Today, Rachel has about $150,000 in net worth between her investments and home equity. David has $45,000 in savings that buys less than it did before. The gap between them is over $100,000. And it's not because Rachel worked harder or was smarter, it's because she understood how money printing affects different asset classes. Rachel positioned herself on the right side of the wealth transfer. David, unknowingly, positioned himself on the wrong side. Here's what most people don't realize. This isn't about morality. It's not about fairness. It's about understanding the rules of the game you're already playing. Money printing is going to happen. Whether you think it's good policy or bad policy doesn't matter. It's the reality of modern monetary systems. Every major economy does it. The question isn't whether you can change that. The question is whether you're going to position yourself to benefit from it or suffer from it. See, there's this idea that investing is risky and savings is safe, and in the short term, that feels true. Investments go up and down, savings stays stable. But over the long term, in an environment where money is regularly printed, the opposite is true. Savings is the risky position. You're guaranteed to lose purchasing power. Investments might be volatile, but they're the safe position because they protect you from inflation. This is the fundamental reframe. Safety isn't about stability of nominal value. Safety is about preservation of purchasing power. When you understand this, everything changes. Debt stops being something to avoid at all costs and becomes a tool you can use strategically. Assets stop being luxuries for the rich and become necessities for wealth preservation. The wealth transfer from money printing isn't inevitable for you personally. It's only inevitable if you don't understand what's happening. Once you see it, you can position yourself differently. You can own assets that appreciate. You can use debt strategically. You can stop thinking your paycheck is your only source of wealth. This isn't about becoming a finance guru or a day trader. It's about basic positioning. Own assets, index funds, real estate if you can, things that rise in value when money is printed. Because here's the truth. The next crisis will come, the Fed will print more money, asset prices will rise, inflation will accelerate, and once again, there will be winners and losers. The difference between David and Rachel wasn't luck. It was understanding. And now you have that understanding too. The first mover advantage, the asset inflation escape hatch, the debt advantage, the velocity lock, the knowledge gap, these aren't abstract economic theories. They're mechanisms that are actively transferring wealth from people who work for money to people who own assets. And they're not going away. As long as we have a monetary system based on debt and central bank policy, this is how it works. But here's the empowering part. You're not helpless. Knowledge is the bridge between being a victim of the system and being someone who can navigate it. You don't need to be rich to start positioning yourself better. You can open a brokerage account with $100. You can start learning about index funds. You can understand the difference between good debt and bad debt. The gap between those who get richer from money printing and those who get poorer isn't about how much money you start with. It's about understanding how money works in the modern economy. David and Rachel started in the same place. The difference was knowledge and action. That's it. So the question isn't whether money printing is fair. The question isn't whether the system should be different. The question is, what are you going to do with the knowledge you have now? Are you going to keep playing by old rules that no longer work? Or are you going to adapt to the reality of how wealth actually accumulates in a world of expansionary monetary policy? 10 years from now, there will be another crisis. More money printing, more wealth transfer. The question is, which side of that transfer are you going to be on?